Welcome to the Founders Journey podcast. Inspiration, education for founders by founders.
Hi, I'm Greg Moran from Evergreen Mountain Equity Partners and the Founders Collective. One of the trickiest aspects of angel investing is understanding how to value a startup. It's something that even professional investors wrestle with all the time because the earlier stage of the company, just the more subjective it really becomes. There's no real clear earnings history or stable cash flow. So valuing a startup can really be like a guessing game. In today's video, I'm going to guide you through some of the most common startup valuation methods. So we're going to get into tips for evaluating fair value and ways to negotiate terms that make sense for both you and the founders and help you avoid some of the common mistakes that occur when you're trying to invest in an early stage company. So by the end of this, you're going to have a strong foundation for assessing valuations in your own investments. Let's start here. Unlike really established companies, startups don't have a stable revenue stream. They may have revenue, but it's not necessarily something that you can really rely on in many cases, or it's very new, and they're just really, it's not a scalable, really predictive revenue stream in many cases, let alone profits, which rarely, if ever, are they going to have any. Early stage valuations are essentially trying to predict future potential than actually measuring current performance, which makes it really difficult. And also what it does is it makes it really subjective. So startup valuation methods really usually rely on assumptions about growth potential, about the market opportunity, and about the quality of the founder and the team, which are really kind of paramount to when you're looking at trying to assess what is the long-term potential of this company and your investment. So when done well, though, valuation really helps align a founder and an investor around the expectations. And really what it does, it allows both parties to set terms that are mutually beneficial and helps the company in the long run to scale, whether that's, bring out enough capital, bring in future capital, things like that. These become really important areas where that early stage valuation has a lot of downstream impacts that, if you don't have experience, you are hard to see coming sometimes. And many founders don't really understand that and really just look at it as the highest valuation I could possibly get is the best one. And that's often not the case at all. Let's get into some of the ways to look at valuation of early stage startups. One popular method is the comparable company analysis, or what's called a CCA. So what this does is it looks at valuations of similar companies in the same industry and stage. Now, oftentimes if you're making investments in technology, there's usually a track record you can follow. There's, it's healthcare tech or it's fintech or something like that. And by comparing recent investments in similar startups, you start to get a ballpark valuation for the target company. Now, things can move, but it will put you within a reasonable radius of knowing if you're in the right, if you're right in the area. So, give you an example. If you're looking at a health tech startup that's really early stage, you can check recent valuations for other or other health tech companies that are at similar stages. Look at the ranges of those valuations. That's going to give you a good ballpark to start your negotiation. So some pros and cons here. CCAs, it's really straightforward. It provides market-based valuation. So it's a pretty easy standard method to get a range. But downside is it can be challenging to find comparable companies, especially if your target startup has a unique model or it operates in like a really niche sector. Sometimes the data is just not really there to use as a comparison. You want to consider, just from a tip, if you're thinking about using CCA as a valuation method, consider the unique qualities of the target startup as well compared to its competitors. Getting those comps doesn't necessarily tell you the exact number or the exact valuation, because you do then want to start to look at those unique qualities, things like the experience of the founder or the team, the technology scalability, differentiation, things like that. And then you can adjust your valuation expectations accordingly based on those things. So the second method that we're going to talk about is what's called the Berkus method. And this is really useful if you're dealing with a very early stage startup. So what Berkus method does is it assigns a value based on 5 core factors. Sound business idea, like what's quality of the business idea, the prototype, Is there one? And what's quality of that? The quality management team, like the quality of the management team. Is it a strong management team? Strategic relationships that maybe the company has, partnerships, things like that give it a unique advantage. And then the product rollout. So if each factor is given a monetary value, typically up to say $500,000, right? Resulting in a maximum pre-revenue valuation around 2 or 3 million is kind of how you would look at this, right? So it's sort of putting a cap on it saying, okay, we're going to value each one of these 5 factors at $500,000. And if we've really maxed out the scale there, we're going to give it full value of, say, the quality of the management team for $500K. Maybe there aren't a lot of strategic relationships, which is another one of those factors, and maybe you're not going to value that as highly. But you end up, if all the factors were maxed at, around 2 to 3 million, and you kind of go downward from there based on what's occurred. Again, this is a really helpful way for pre-revenue companies where you can't value the revenue stream at all. It doesn't exist. The nice part with the Berkus method, it's really easy to apply. And it's ideal for startups that have no financial history at all. Right? It just kind of brings some objectivity to something pretty subjective at that point. The downside really is because it is so subjective, you really have to look at each factor's value, and it's really going to come down to your judgment as an investor rather than any kind of financial model. It's a good approach, though, if you're dealing with a pre-revenue company, but you got to be realistic here. You really avoid inflating values unless the startup clearly meets or exceeds each factor. Again, I would sort of call it objective subjectivity, but it gives you something to use for pre-revenue investments. Next one we're going to talk about is something you may be familiar with, discounted cash flow or DCF method. And this is much more suited to later stage startups that have some revenue history. So what this does is it projects future cash flows and then discounts them back to present value on a risk-adjusted rate. DCF is actually used in larger companies as well. Essentially what it does is it asks, how much is the company's future revenue worth? So what do I believe the future revenue is going to be? And then what's that worth to me today to buy that revenue potential? So give an example, because this can be kind of theoretical. If a startup is projecting 5 million in revenue in 5 years, then what DCF does is it helps calculate today's value of that revenue after accounting for risk. Let's say we think in 5 years, that revenue, the company's going to be at 5 million. Well, there's a lot of risk in getting to that 5 million. So what today do I believe? Maybe if it did actually get to that 5 million, maybe it'd be worth 4 times that 5 million or something like that. But you're obviously not going to pay that today. When you start to put in the risk, maybe that, example of 5 million in 5 years times 4, right? Multiple of 4 on that, 20 million. But maybe you think today, like, hey, there's probably only a 20% chance they're going to achieve that. So then you're looking at, something like a $5 million valuation or something like that, right? So different ways to do this. But again, what you're looking at is what do you believe that future revenue is going to be in some period of time? What DCF does is it provides a really detailed quantitative valuation. You can use the company's own financial model if you believe the company's financial model to be true. That's also the downside. It requires really solid projections. You have to believe them. And this is why it's often used for later stage startups, because early stage startups often don't have reliable projections. They're guesses. And those guesses then become really highly sensitive to that whatever discount rate you're going to apply. So the more reliable revenue history exists, the more DCF becomes a really good way. So if you're investing in really early stage startups, use it cautiously. If the revenue projections seem overly optimistic or assumptions really feel shaky, or there's just not a history to go on to know if these things are realistic at all. If you're going to use DCF, you want to make sure founders are using a conservative scenario, or you may just want to use another method. The venture capital method, this is something that we use as well as at Evergreen Mountain Equity Partners, a venture capital firm. It's popular among early stage investors, and it's based on target returns. Okay, so this is something that one of the ways that we value companies. So first, we're going to look at what do we believe the exit value is? What's the potential of that exit value? So the potential value at the time of sale or IPO or whatever. We use our own exit value, right? Not necessarily we're early stage investors. We may not be in it until IPO or something like that. So we're looking at what do we believe the exit value is to us. Then we kind of work backward to really calculate today's value based on that target return. So let's say if we want a 10x return and we believe the company could exit at 100 million in 5 years, 10 years, 7 years, whatever it is. Today's pre-money valuation would be 10 million, right? 10x return, 100 million, 10 into 100 million, $10 million would give us that potential of a 10x return at 100 million. So again, one way to do it. The nice part is it aligns with the expected returns, which makes it really attractive to investors. But the downside is it relies on a really speculative exit value, and it could be overly optimistic if market conditions really change along the way, which again, our hold periods can be, 5 years or more. So you will have market cycles in there, which means you really want to be able to get your exits when the market is at its best. So when you use the VC method, you want to really ensure that the exit assumptions are realistic, right? What do we really believe that this could be? And then you want to validate that exit value based on similar companies that have successfully exited. So this is where you start to kind of combine it with that CCA model, right? Look at other companies. What did they exit for? Is the assumed valuation that you're using on exit realistic? If nobody has ever exited in this space for more than 100 million, there's probably not a good factual basis to believe you're going to exit for $1 billion. So just things to look at. The last one I want to talk about is a little bit different, right? Because the valuation methods that I all talked about are focused on numbers. But the thing that it doesn't account for is the quality of the founder and the critical role that the quality of the founder plays in valuation, especially in early stage companies. It gets less important as a company gets more mature, but at an early stage, it's really key. A great founder can increase the likelihood of success and improve the company's valuation over time. There's no doubt. It's often one of the top, if not the top determinants of the future value of a company. So at Evergreen Mountain Equity Partners, we built a proprietary founder assessment that really evaluates essential traits like resilience, adaptability, strategic accountability, and other ones, because we really believe that founders who demonstrate these traits are much better positioned to navigate challenges and grow the company, which has a huge outsized impact on the long-term valuation. A founder with a really strong track record and the right qualities can justify a higher valuation. We will pay a premium for that if we have a lot of conviction around the ability of this founder. Conversely, if we think that the founder lacks these qualities, we probably won't invest, or maybe they do have these qualities, but they don't have experience, we may negotiate a little bit lower valuation because the risk is a little bit higher. Before we close out, I want to talk real quickly about just some tips on negotiating a fair valuation. So once you've determined a reasonable valuation range, it then comes down to negotiation. So here's a few tips to really keep in mind. One, you got to be transparent. Share your valuation assumptions with the founder and talk it through. What it's going to do is it's going to build trust. It's going to build a collaborative approach when you arrive at these numbers. Quite frankly, people get really carried away with negotiating valuations. In an early stage company, $1 million, $2 million in either direction is not going to make a long-term difference to your return. Really share the assumptions that you're using in your valuation to make sure that there's alignment between you and the founder. And the next tip is you want to really highlight risks and the adjustments you're using. So if you believe that the startup has higher than average risks, maybe you believe that there's regulatory challenges, things like that. You want to really factor these into the valuation. Again, be honest, be transparent with the founder when you're going through this. Third, you want to consider non-monetary terms. If you can't agree on valuation, what you can do is propose other equity-like based compensation or milestone-based tranches that align with your risk tolerance. This is something that we have done a lot at Evergreen, where maybe the founder's looking for a much higher price than we are willing to pay at that point. What we have done, and we routinely do this, is then structure it to say, okay, we'll invest less today. And if you go hit these milestones, we'll give you the price you're looking for with a second tranche or something like that. So you can stage these things out a little bit as well and put some proof in there to make sure that, the founder is able to go and execute along the, to support a higher valuation. If they do, great, pay the higher valuation. Negotiation doesn't always mean just lowering the price. Sometimes it's about structuring the investment in a way that really aligns interests and mitigates risks. To wrap it up, startup valuation is part art, it's part science. It's definitely more art than science. But by understanding these methods like comparable company analysis, the Berkus method, DCF, the VC method, they give you some tools to use in your toolbox to be better equipped to assess the fair value of a company. Remember, a great founder can add value well beyond the numbers, which is why we at Evergreen Mountain prioritize founder selection and the assessment of founders in our valuation. So if you're interested in exploring more about startup investing, learning more about valuation strategies, or our unique approach to founder assessment at Evergreen Mountain Equity Partners, or adding venture capital, earlier stage investing, seed level stage investing in a diversified portfolio as part of your asset allocation strategy, reach out to us. Go to emep.io. We'd love to talk to you, discuss how we can support your investment goals. And thanks for watching. Don't forget, please take a moment, like, subscribe, hit the bell to turn on the notifications to get more content like this. And feel free, please, to leave any questions or comments below. Thanks. See you next time.